Okay, let's unpack this a bit. Have you ever looked at an investment statement, maybe seen some gains, and wondered, was that pure genius or just good timing?
Right. Like, was it skill or just a rising tide lifting all boats? It's a fundamental question.
Exactly. How do you really spot the skill in a market that, let's face it, often feels driven by luck? Today, we're diving into a really crucial metric called alpha, finance and investment alpha.
Yeah, and think of this deep dive as, well, a shortcut, a way to quickly get your head around what alpha really is, why it matters so much, and how it helps you, the listener, assess the true value added by investment decisions, beyond just the market going up or down.
So demystifying it, that's the mission.
That's the mission.
Yeah.
Cut through the jargon, see the difference between luck and actual expertise.
Okay, so at its core then, alpha,
Yeah.
it's what we call the active return on an investment, right? So think of it as the slice of your returns that isn't just because the whole market went up. It's supposed to be the direct result of a manager's specific choices, their skill.
Exactly. Their skill in, say, picking the right sectors or finding those undervalued companies, maybe even managing risk better than the average. It's that specific contribution.
And this is where it gets important, I suppose.
Oh, absolutely.
Yeah.
This is where the rubber meets the road. A positive alpha. That means the manager actually beat their benchmark. They added value.
And negative.
Negative alpha means they underperformed, even if the market itself was positive. Zero alpha means they basically just tracked the market, performed as expected given the risk.
So for active fund managers, the ones charging fees,
Generating positive alpha consistently is the goal. That's how they justify those fees you pay. Because honestly, without it, you might as well be in a cheap index fund just getting market returns.
right, you're paying for that potential outperformance.
Yeah.
Which brings us to alpha's cousin, beta. You almost always hear these two together.
You do. They're linked but very different.
So beta, that measures an investment's volatility. It's systematic risk relative to the market.
Precisely. Systematic risk. You can't just diversify away like big economic shifts.
So a beta of 1 means it moves with the market. More than 1, more volatile. Less than 1, less volatile. Simple enough. But what's the key difference with alpha?
Okay, this is crucial. Beta tells you how much market risk an investment takes on. Alpha, on the other hand, measures the return that is not explained by that beta.
So it's the leftover return, the bit that comes from the manager's specific decision.
Exactly. It's the value added separate from just riding the market wave. It isolates the manager's unique skill, finding opportunities or dodging risks the broader market doesn't automatically account for.
Got it. So alpha isn't just some abstract number for finance geeks. It has real practical meaning, especially if you're investing or working with a wealth manager.
Huge practical meaning. Wealth managers rely on showing consistent positive alpha. It's how they demonstrate their value, justify their existence, really, and those fees.
And if it's consistently negative,
Then you really have to ask, right? Are you getting value for your money? Or could you potentially do better, or at least similar, with a much lower cost passive strategy, like an ETF?
which leads into this broader idea you mentioned, wealth planning alpha. That sounds like it goes beyond just picking stocks or bonds.
It absolutely does. It's a much wider lens.
Yeah.
It includes all the other value a good financial advisor brings to the table, beyond just investment returns.
Like what, specifically?
Things like smart tax strategies,
Mm-hmm.
effective tax loss harvesting, for example. Some studies suggest that a loan can add, maybe 1 to 3% in net returns each year for clients.
Wow, okay. That's significant.
It is. And it also covers things like optimizing your estate plan, making sure that's efficient, and maybe most importantly, behavioral coaching.
Behavioral coaching.
Yeah, helping you avoid making those panicked emotional decisions during market sell-offs, stopping you from selling low and buying high. That adds tremendous value over time. It connects alpha directly to your overall financial well-being, not just the daily portfolio ups and downs.
Okay, that makes a lot of sense. So how do professionals actually, measure this skill part, this alpha? Is there a standard way? You mentioned Jensen's alpha.
Yeah, there's a widely used formula, Jensen's alpha, often derived from the capital asset pricing model, or CAPM.
Sounds complicated.
Well, the formula itself can look a bit daunting, but honestly, you don't need to memorize it. The key is understanding why it's used.
Oh, okay, so what's the purpose?
Its purpose is to calculate the difference between what a portfolio actually returned and what it should have returned, theoretically, given the level of market risk its beta that it took on.
So it isolates the extra bit.
Exactly. It helps rigorously determine if the return came from the manager's genuine skill that's your alpha, or if it was just down to taking on more risk or the market doing well overall. Skill versus luck and risk.
Right. So wrapping this up then, what's the big takeaway here? You now have this powerful lens, this idea of alpha to kind of cut through the noise and really understand investment performance, to separate that active management skill from just, well, market movements.
Yeah, and that leads us to maybe a final thought, something for you, the listener, to chew on. How does understanding alpha, especially this broader idea of wealth planning alpha, how might that change the way you look at financial advice?
Or even your own investment strategies.
Exactly. What kind of extra quantifiable value should you really be demanding or looking for? Beyond just what the market happens to deliver on any given day. What's that true added worth?